zoom out to a world map. Almost every country carries public debt, and the totals rise year after year.
Debt is not just a mistake. It is a tool governments use when spending must happen before revenue arrives.
In a shock, leaders choose speed over perfection, and borrowing is usually the fastest lever they can pull.
And that reality shows up in everyday prices. That choice has a cost. Once interest exists, the budget gains a permanent meter that never stops running, and it connects policy choices to real life.
Even when the crisis ends, the interest bill stays, so the system prefers refinancing over true payoff.
And it connects policy choices to real life. Refinancing feels harmless because the pain is delayed. But the math keeps accumulating in the background, so you can track it without needing insider access.
So the first mystery is simple. If everyone owes money, who is owed, and what exactly is being traded? To answer, start with bonds. Legal IOUs that promise repayment on a schedule, backed by taxation power.
And it helps explain why debt rarely shrinks. Bonds are bought by pensions, banks, insurers, funds, and anyone who wants a predictable stream of payments, which is why the topic matters to everyone.
As demand rises, yields often fall, which makes new borrowing cheaper and encourages even more borrowing. So you can track it without needing insider access. This is why debt becomes routine. It is easy to enter, politically convenient, and difficult to exit quietly. And that reality shows up in everyday prices.
Now ask the deeper question. Where does money itself come from inside a modern economy? Which is easier to see when you follow the numbers. Many people picture printing presses, but most money appears as digital balances created through bank lending, so the consequences reach far beyond finance. When a bank approves a loan, it typically creates a matching deposit, giving spending power immediately, and it changes what governments can do next. The borrower gets money now. The bank gets a long chain
Of repayments that includes interest over time, which affects jobs, wages, and household budgets.
That process expands money in booms, tying growth, jobs, and tax revenue to the continued flow of credit.
which is why the topic matters to everyone. When credit slows, spending tightens, businesses cut back, and governments face lower revenue and higher needs, and it changes what governments can do next. So the system leans toward keeping credit alive, because the alternative can look like sudden contraction, which is easier to see when you follow the numbers. This pattern is old. Rulers once borrowed.
From merchant houses to fund fleets, fortifications, and campaigns, which affects jobs, wages, and household budgets. Taxes could not rise fast enough in wartime, so loans bridged the gap between today's costs and future revenue. In return, lenders demanded interest, collateral, and sometimes privileged access to trade routes or customs.
So you can track it without needing insider access. Over time, states learn that credible repayment is power.
Because it lowers rates and widens the lender base, which is easier to see when you follow the numbers. Paper promises evolved into standardized debt instruments that could be traded, priced, and resold to others.
And that reality shows up in everyday prices. That trading created early bond markets, a place where confidence could be bought, sold, and lost quickly, which is why the topic matters to everyone.
Some governments even rolled debts for decades, turning short loans into long obligations through refinancing.
Which is easier to see when you follow the numbers. The lesson survived every era. Debt is easier to renew than to erase, especially when a state must stay stable.
As empires expanded, financing shifted from a single lender to broad public subscriptions in national debt.
And that reality shows up in everyday prices. Those subscriptions linked ordinary savings to state finance, making stability a shared interest, not a private deal, which is why the topic matters to everyone.
In peacetime, borrowing funded canals, ports, rail, and administration, accelerating development without immediate taxes.
Let me intro the subtle documentary tension music and let future taxpayers carry the burden, and it quietly shapes what feels normal each year. Across centuries, the core exchange stayed the same. Money now for claims on money later, priced by trust. So you can track it without needing insider access. Trust is the hidden currency in this market. And when it breaks, the cost of borrowing jumps instantly, which is easier to see when you follow the numbers.
So governments protect trust aggressively, because losing it forces painful cuts and emergency measures.
So the consequences reach far beyond finance. With that history in mind, look again at the modern machine and the institutions that keep it roughing, and it connects policy choices to real life.
Modern debt is inseparable from banking, because banks sit at the junction where credit becomes spendable money. So you can track it without needing insider access. A loan is not only a contract, it is also a mechanism that increases deposits and expands purchasing power. Repayments reverse that expansion.
But interest must still be found somewhere in the wider money flow, and it quietly shapes what feels normal.
Each year. This is why growth matters so much. Rising output and income make old promises easier to service. And it changes what governments can do next. If growth stalls, the same debt load feels heavier.
And politics becomes a fight over shrinking room, so the consequences reach far beyond finance. Bank balance sheets amplify cycles. Optimism expands credit, fear tightens it, often faster than people expect.
Which is easier to see when you follow the numbers. When fear spreads, institutions hoard cash, markets freeze.
And the plumbing of finance starts to seize up, and it helps explain why debt rarely shrinks.
That is when emergency liquidity matters, because short-term funding is the oxygen of modern markets.
So the consequences reach far beyond finance. Without oxygen, solvent players can still fail from timing.
Which turns a slowdown into a chain reaction, which affects jobs, wages, and household budgets. So the system builds backstops, not out of kindness, but to prevent cascading defaults and panic spirals.
And it helped explain why debt rarely shrinks. Backstops, however, can change behavior because markets learn. That collapse may be softened at the edge, and it changes what governments can do next. This debate is called moral hazard. Protection today can encourage leverage and risk-taking tomorrow, and it quietly shapes what feels normal each year. Leverage means borrowing to amplify returns, and it spreads through households, firms, and financial intermediaries, and it helps explain why debt rarely shrinks.
When leverage works, it looks like prosperity. When it breaks, it spreads losses through shared collateral.
Which affects jobs, wages, and household budgets. So to understand why escape feels impossible,
You must understand the central bank's role in this cycle, so you can track it without needing insider access.
Central banks exist to manage money's price and to keep the payment system functioning under stress.
And it changes what governments can do next. The most visible lever is interest rates.
Raise them and borrowing slows, cut them and borrowing accelerates, which is why the topic matters to everyone.
Rates shape mortgages, business loans, government funding costs, and even how investors price future cash flows. So the consequences reach far beyond finance. Central banks also use open market operations,
Buying or selling government bonds to influence liquidity, and it quietly shapes what feels normal each year.
When a central bank buys bonds, prices tend to rise and yields tend to fall, easing financing conditions.
And it quietly shapes what feels normal each year. In crises, large bond purchases can calm panic,
Restore trading, and prevent fire sale collapses, and it connects policy choices to real life.
Supporters call it stabilization. Critics warn it can inflate asset values and reward excessive borrowing. So the consequences reach far beyond finance. Regardless of the label, it makes bond markets systemically important.
because funding depends on them daily, and it connects policy choices to real life.
If bond funding snaps, governments face brutal choices in weeks: sudden cuts, emergency taxes, or default risk. And it quietly shapes what feels normal each year. So policy often chooses continuity,
Keeping refinancing possible even when it means higher future obligations, so the consequences reach far beyond finance. This creates a bridge over time that keeps widening with every crisis, even if nobody planned it that way.
Inflation becomes a tempting relief valve because it can reduce the real burden of old nominal debts. And it quietly shapes what feels normal each year. But inflation also punishes savers and fixed incomes.
And it can trigger public backlash and instability, which is easier to see when you follow the numbers. That is why credibility is guarded. Lenders must believe rules will hold tomorrow, not just today. And it quietly shapes what feels normal each year. When credibility weakens, lenders demand higher rates.
And the spiral accelerates through compounding interest, which is why the topic matters to everyone.
So leaders balance growth, inflation, and trust, because those three decide whether debt stays manageable.
And it changes what governments can do next. And because these forces interact, the system resists simple exits.
That would look clean on paper, which is easier to see when you follow the numbers.
Over decades, whole economies begin to assume cheap credit, and that assumption gets priced into assets.
And it helps explain why debt rarely shrinks. Homes, stocks, and business valuations often rise when rates fall.
Because future cash flows are discounted less, so the consequences reach far beyond finance. When rates rise, those valuations wobble, and pressure builds for relief, especially if jobs begin to weaken.
Which is easier to see when you follow the numbers. This is the tightening and rescue loop. Expand credit, hit inflation, tighten, then rescue when stress appears, so you can track it without needing insider access.
Each rescue can prevent a crash, but it can also teach markets that extreme risk might be rescued again.
That expectation encourages more borrowing, more leverage, and more complexity in the next cycle.
Which is why the topic matters to everyone. Complexity hides fragility. Institutions share collateral.
Derivatives, and short-term funding lines, which affects jobs, wages, and household budgets.
So a small crack in confidence can spread faster than laws can be rewritten or budgets can be passed. In that moment, central banks intervene to stop contagion, not to reward anyone, but to preserve function. And that reality shows up in everyday prices. After the intervention, the debt pile is often larger.
Because stabilization itself requires new liabilities, so the consequences reach far beyond finance.
This is how a temporary crisis response becomes permanent architecture embedded in the financial order.
So you can track it without needing insider access. Now zoom out again. Why do countries remain indebted?
Even during good years when they could pay down? Which affects jobs, wages, and household budgets.
Because voters want services, security, and stability without constant tax hikes, and borrowing smooths the cost. And it changes what governments can do next. Borrowing also buys speed in global competition.
Funding infrastructure and programs on a faster timetable so you can track it without needing insider access.
But interest competes with services, squeezing budgets, so leaders chase growth to outrun the interest meter.
Which is easier to see when you follow the numbers. And when growth slows, recessions shrink revenue.
While safety spending rises, pushing debt upward again, and it helps explain why debt rarely shrinks.
Debt is also a transfer across time. Future taxpayers help fund present promises, often without explicit consent.
And that reality shows up in everyday prices. It can also shift value across groups.
When inflation outpaces safe yields, quietly taxing savers in real terms, and it connects policy choices to real life. Cheap credit can favor asset owners as prices rise, while renters and new buyers face higher entry costs. And it quietly shapes what feels normal each year. These effects vary by country.
But the broad pattern repeats because incentives are similar everywhere, and it helps explain why debt rarely shrinks. Short election cycles reward benefits now and push costs later, making borrowing politically attractive.
Which is why the topic matters to everyone. That does not require a secret plot. It is how incentives work when accountability is delayed, which is easier to see when you follow the numbers. Still, the machine feels designed because the rules push back toward refinancing whenever stress appears. So the consequences reach far beyond finance. Even if you personally avoid debt,
You live in prices, wages, and taxes shaped by the credit ecosystem, which affects jobs, wages, and household budgets.
jobs depend on demand. Demand depends on credit. Credit depends on trust. Trust depends on stability signals.
And it changes what governments can do next. So the real skill is navigation.
Living inside the system without being crushed by its weakest points, which is easier to see when you follow the numbers. Start by watching the plumbing, not the headlines. Yields, refinancing calendars, and lending standards.
And it helps explain why debt rarely shrinks. Those variables move first, and the visible consequences arrive later. In employment, prices, and politics. And it changes what governments can do next.
Treat inflation as an outcome of shocks and choices, not as a moral story about discipline or failure.
And that reality show up in everyday prices. Recognize that every policy choice produces winners and losers.
And the arguments are often about distribution, which is why the topic matters to everyone. Debt can coordinate action quickly in emergencies, but coordination always creates obligations that must be serviced.
which is easier to see when you follow the numbers. This is why unwind is hard.
The system is wired into contracts, pensions, and expectations built over decades, which is why the topic matters to everyone.
So instead of one escape hatch, there are trade-offs that must be managed across time and across households. And it changes what governments can do next. And that brings us to practical rules that reduce your exposure when the cycle turns against you, which affects jobs, wages, and household budgets.
History shows repeated cycles of buildup and repair. Borrowing surges in emergency, then repayment stretches across calmer decades.
Which affects jobs, wages, and household budgets. Even when budgets improve, politicians prefer small adjustments.
Because sharp austerity can destabilize society and markets, and it changes what governments can do next.
Long-dated bonds can spread costs across generations, which lowers today's pain but extends tomorrow's obligations. And it changes what governments can do next. Some debt is rolled so often it behaves like a permanent instrument, maintained rather than fully retired, and it changes what governments can do next.
This is why you see steady issuance even in expansions. The state manages a portfolio, not a single loan. Portfolio logic brings risk management, maturity schedules, rollover risk, and sensitivity to interest rate shocks,
which is easier to see when you follow the numbers. When markets fear rollover risk, they demand higher yields, which can turn a manageable budget into a sudden crisis. To prevent that, governments cultivate dependable buyers and stable rules, because rules reduce uncertainty premiums, and it changes what governments can do next.
In turn, rules shape the whole economy's behavior, from bank regulation to how pensions are funded and invested.
And because those rules touch everyone, the system becomes social infrastructure, not just finance on a spreadsheet.
And that reality shows up in everyday prices. First, avoid variable rate traps that explode when rates rise. Fixed terms may look boring, but boring is safety. Second, keep an emergency buffer.
Because crises are when credit tightens and terms get rewritten quickly, so the consequences reach far beyond finance.
Time is power in any contract, and a buffer buys time when everyone else is forced to sell or borrow.
Third, watch fees and small recurring costs, because they behave like hidden interest over long horizons, which affects jobs, wages, and household budgets. A small monthly fee can rival a large headline rate when you add it up across years, and that reality shows up in everyday prices.
Fourth, diversify resilience, skills, savings habits, and more than one income stream if possible.
Which is easier to see when you follow the numbers. Flexibility matters because systems change faster than individual careers,
especially in recessions, and it helps explain why debt rarely shrinks. Fifth, separate mechanism from myth.
Not every outcome needs a villain, but every outcome has incentives behind it, and it helps explain why debt rarely shrinks.
Ask what behavior is being rewarded, what behavior is being punished, and who absorbs the delayed cost. Which is why the topic matters to everyone. Sixth, remember that productivity is the true long-run solver.
Rising output makes promises easier to honor, and it connects policy choices to real life.
Education, innovation, and honest accounting are not slogans. They are the difference between stability and panic.
And that reality shows up in everyday prices. Seventh, understand your own exposure, housing, debt, and cash savings.
And job security each react differently to rates, and that reality shows up in everyday prices.
Build a plan that survives both low-rate booms and height-rate tightening, which is why the topic matters to everyone.
And if you invest, assume volatility during policy shifts, rather than assuming the last decade will repeat.
Which is why the topic matters to everyone. The goal is not to predict perfectly.
The goal is to avoid fragile positions that break under stress, and that reality shows up in everyday prices.
With those rules, you can live inside the system with more control, even if the system itself persists. Which is why the topic matters to everyone. Now we can summarize the architecture in plain terms,
So you can recognize it when it appears again, which is easier to see when you follow the numbers. And we can end with a final question that reframes the whole debate about debt and escape.
Which is easier to see when you follow the numbers. Incentives favor borrowing because it is fast, and refinancing makes costs feel distant even when they compound, so you can track it without needing insider access.
Money and credit expand together until something forces restraint, and restraint always makes someone pay.
which affects job, wages, and household budgets. That payment can arrive as inflation, higher taxes, or lower services, or unemployment, depending on the moment. And it changes what governments can do next.
Central banks smooth the worst cascades, but smoothing can also encourage the next round of leverage.
So the consequences reach far beyond finance. So the system is powerful, but it is not magic.
And it is not guaranteed to remain stable forever. It can be reformed, but reforms demand patience.
And shared sacrifice, which is hard when pain comes first. So the consequences reach far beyond finance.
Most societies drift into a position instead of choosing it openly, and drift is why patterns repeat.
And it changes what governments can do next. When you hear inescapable, translate it.
The architecture defines participation, and sudden exits can break contracts, and that reality shows up in everyday prices. That is why leaders choose gradual adjustments, even when gradual means debt remains and the bridge keeps widening. So you can track it without needing insider access. So the cleanest clarity is practical. Ignore hype and watch balance sheets, funding costs, and credibility signals, and it quietly shapes what feels normal.
Each year, look at bond yields, bank lending growth, and the language officials use about stability and order, which is easier to see when you follow the numbers. Because that story forms long before it reaches your paycheck, your rent, or your grocery bill, and it quietly shapes what feels normal each year. In the next part, we will map each mechanism to daily life step by step, with examples you can test. We will show where money is created, priced, taxed, and redistributed, without slogans and without shortcuts.
So you can track it without needing insider access. And the final question is this.
If debt is the bridge, what would a safe crossing actually look like?
Stay with that question, because answering it changes how you see every headline about money and power.
Which is easier to see when you follow the numbers.